Defensive investors. Benjamin Graham, in the 14th chapter of The Intelligent Investor, lays out his criteria for defensive investors. What is a defensive investor? According to Ben Graham, a defensive investor is an investor who is unwilling or able to put the time and effort into being an enterprising investor, or someone who is able to monitor their portfolio in an active basis. Chapter 14 of The Intelligent Investor. In Chapter 14, Graham lays out his ideas around the criteria to be a defensive investor. In the chapter, he describes two portfolios: a Dow Jones type of portfolio consisting of the top names in the exchange, or a quantitatively tested portfolio. The 7 criteria: adequate size, at least $2 billion in market cap; strong finances, at least a 2-to-1 current ratio, also with long-term debt not exceeding working capital; earning stability, at least 10 years of positive earnings; dividends, companies that pay a dividend for at least 20 years consecutively, or dividend aristocrats being the perfect vehicle; earnings growth, looking for companies that have grown earnings over 10 years of 33% or around 3% average annually; PE ratio, looking for a moderate PE ratio, less than 15 over the last 3 years. Best to use average earnings over 3 years compared to forward earnings. Price-to-book ratio. Graham is looking for a price-to-book value less than 1.5, or a blended multiple of the current PE times the price-to-book of less than 22.5 for reasonably priced companies. Use of the 7 criteria. It is meant as a screening criteria to find conservative investments. Graham meant for the 7 criteria to help defensive investors find strong companies with great financials that are consistent earners that wouldn't take much oversight to add to their portfolios, while allowing them to enjoy safe returns without much worry. If you have not read The Intelligent Investor, run, don't walk to your nearest bookstore or Amazon and buy it. The book is worth your time and money. Defensive investors. Please enjoy the rest of the post.